SurePoint Advisors is an investment advisor in Brielle, New Jersey. SurePoint Advisors is registered with the Securities and Exchange Commission. Registration of an investment advisor does not imply any specific level of skill and does not constitute an endorsement of the firm by the Commission.
Welcome to another episode of SurePoint Advisors Financial Roll Call with James Fay. We are 10A in service. This is a podcast for law enforcement by law enforcement. I am James Fay. I'm a retired law enforcement officer and now financial advisor with SurePoint Advisors. And I'm focused on helping law enforcement officers make educated financial decisions that will directly affect their retirement. I truly believe that this podcast will help accomplish that. All right, today's episode, we're going to bring back a familiar guest. We're going to bring back Anthony Marone to give us the rules of refinancing. You know, I get a lot of calls in the office about refinancing or, is it a good time? Whatever the questions might be. So I figured let's bring Anthony back on and let him give us the rules of refinancing. So with the 10-year treasury being creeping up now, actually it's on its way up, interest rates are going to go up and mortgage rates are going to go up. So what better time to talk about this than now so people can make their decision before maybe they get a little too high, right? So let's hear what Anthony has to say in our interview that we did earlier in the week.
Welcome to another episode of SurePoint Advisors Financial Roll Call with James Fay. We are 10-8 in service. This is a podcast for law enforcement by law enforcement. All right, I'd like to welcome back Anthony Marone to the podcast. Anthony, I told our listeners during the first episode that we had done together here that you would be back. And here you are for your third episode with us here on the podcast. So I appreciate you taking the time to out of your busy schedule to educate our listeners. And, there's so many different topics, like I talked about before, in and around mortgages that I'm sure we'll have several more of these episodes with you as well. So I figured today that since mortgage rates have been and still kind of are at a historically low rate, that maybe it would be beneficial for the listeners to do an episode on the rules of refinancing a mortgage. So maybe to start, you could just give a general brief definition of what refinancing means.
Sure, absolutely. And thanks, James, for having me back. My pleasure being here as well. Yes, the refinancing is, this past year has been a great opportunity for a lot of people to take advantage of historically low rates. We saw rates very low, and, the past couple of weeks, they're really starting to creep back up there. Mostly due to inflation. We now have the coronavirus vaccinations out. Businesses are starting to open back up. So with a rising economy, we're going to have, obviously, increased rates. So we'll continue to see rates go up. I think rates are going to continue to increase. So now is really the time to, do a refinance if that's what we're looking to do. So the way the refinance works is pretty much you have a lien on your property currently. Might be a first lien, you might have a first and a second lien, depending if you have, home equity line of credit or something to that nature on that property. So what a refinance will do is pay off that lien or liens, and then we'll put a new lien on your property with a lower interest rate or cash out, or however you want to work it. There's a few different ways we can work a refinance, but typically we're paying off that a lien on the property, and then we're adding a new lien on with a different agreement of as far as rate and term goes.
Right. So just basically replacing one existing mortgage with another mortgage. That's really what it comes down to, the general,
correct,
definition of a refinance. Yeah. So let me ask you this, some general rules of when you should refinance. I know you were starting to get into that probably, but figured I'd ask the question.
Sure, absolutely. So for everybody, it's kind of different. It all kind of depends on everyone's financial objectives. Believe it or not, I have a lot of clients that call me up and want to refinance, and I talk them out of it. We always try to do what's best for the client, and sometimes people call me up and just run some scenarios by me, and a lot of times we tell them just stick where you're at based upon long-term goals. A lot of the time they're in that house. Basically, kind of we look at their financial picture and kind of help them make a decision on what's the best move for their family. But yeah, usually pretty much any time we can get a good rate change on it, whether it's dropping that rate down significantly or reducing the term of that mortgage, right? So we sometimes have clients that will go from a 30-year down to a 15 or a 20, and we kind of go over that with the financial advisor and make sure they're checking off all the boxes for all their long-term goals as well before we drop them down into different terms. Some just want to save money per month to put money back in investments, stuff of that nature. So what we'll do is we'll put them back to 30 sometimes and reduce their payment dramatically, have the big monthly cash flow for other investments and other areas of security as far as investments goes, 529, stuff all to that nature.
Right.
Some clients have two liens on the properties or multiple liens on the properties. What we could do is we could refinance both of them as a cash out refi and consolidate them to one lien, or we can just refinance the principal lien and keep the second lien subordinated so that's still there. So there's a few different things we can do for refinances. Sometimes people want to refi a combination of things to consolidate debt, maybe drop off PMI as well. So when we look at doing cash outs and paying off some additional debts as well as the first lien position, that the goal of that is to free up a lot of money. So we'll take that monthly cash flow and free up multiple credit lines that they have balances on. So now by rolling that money, consolidating that debt, their monthly payments dropping significantly, and now they have cash flow to do other things with.
Right. That's great. You gave a lot of great information as to, as to why homeowners might refinance. There was a lot of benefits there. That's for sure. So let me ask you this. Is there any downside to refinancing your mortgage?
Yeah, so the only thing is just closing costs involved. So what happens is usually in New Jersey, it's 5 months of taxes, 1 year of homeowners insurance if it's due, title insurance to make sure there's no new or additional liens on the property. That's mandatory in New Jersey on every purchase or refi. So the costs can start creeping up. We can add the closing costs back into the loan amount, which a lot of clients tend to do. The positives on that, though, is after the refinance, we can usually skip the clients 1 to 2 months of their current mortgage payment, and then they'll receive their escrow check back from their current lender. So by the time we add up 2 months of mortgage skipping to get their escrow check back, it's kind of very close to a break even for the cost of the refi. So then we'll take their savings a lot of times, and usually it's a couple months break even or a year break even by the time we add up all the numbers of them skipping 1 to 2 months of their mortgage payment to get their escrow check back. It's usually a washout. So some clients, when they get that money back or they save that money by not making those 2 payments, sometimes they'll make a principal payment after closing onto their mortgage to get the loan amount kind of back down to where it was originally. Other clients tend to take that money, put it in investments, maybe put into whatever accounts they have for a year, or the clients keep in their savings account or pay off debt. So depending on the client and their financial situations, everyone can do something different with that money, but that money is there to do whatever they want with it.
Great. That's great. So there is a little bit of a downside in the cost, if you will, but like you said, you can recoup that with the, rolling it in to 2 months off and then getting your escrow back from your previous mortgage. So it was good. You did touch on one thing, though, there. You said about break even. And I think it would be important maybe to speak a little bit about the break even period in refinancing and what that means. So if you could just explain that to our listeners, that'd be great.
Sure, absolutely. So with the cost of the refi, we want to make sure that it's worth it for you to do. I had a client the other day, he was going to move in about 1.5 years to 2 years. And we looked at the numbers and we said, by the time you lay out the money, you go through the whole refinance process, you're going to move anyway. Let's not add that money to your loan amount, and let's just sit tight where you're at, and then we'll focus on you buying a new house, 18 months from now. So it's not definitely a thing that every client should take advantage of. It all depends on kind of everyone's financial situations, their long-term goals, what their plans are in the future. We have to take everything into account before just doing a refinance. So when we add that money to that loan amount, it could be up significantly. So if they're going to sell in a year, well, now let's say, for instance, we added $7,500 to their loan amount. When they sell their house, they're going to pull back $7,500 less from their sale. And then, IRS guidelines, Section 121, if it's your primary residence for 2 years or more as a single person, $250,000 tax-free without capital gains. Married, $500,000 profit. So now you're eating away into your tax-free profits as well onto those. So it's kind of, every refinance that we look at, we want to take everything into account, look at the full picture before making an educated decision on what to do.
Right. That's great. And it looks like that you're really concentrated on service. You talk about taking a holistic view of everything they have going on. You're not just looking for the sale. So that's important. Your service. And again, I said this before in previous episodes that I know firsthand, that you pride yourself on your service, and that's great. So our listeners should really understand that and appreciate that. Let's touch a little bit about on credit score and how that relates to refinancing. What credit score is generally needed to refinance, and maybe you can explain how the credit score affects a mortgage rate.
Sure, absolutely. So we kind of want to see a good credit score when refinancing. Obviously, credit score is going to affect your rate. Certain loan products, it'll affect the rate more than other loan products. So it kind of depends on what kind of loan product you're in versus the rate. Sometimes we'll make recommendations when we start a file, maybe look at a credit report, and I might be able to tell the client, hey, pay these 2 debts down below 30%. We'll rapid rescore your credit, and we'll get your credit score projected to X in 30 days, X credit score in 60 days, X credit score in 90 days. So that's a unique ability that we have. It's called a rapid rescore. We can kind of do a what-if scenario and see where the credit score is going to go. So it kind of really depends on everyone's situation and kind of what loan product they're in. But on a typical conventional loan, you really want to be upwards of 680, 700 easily. Every 20 points there on after is you get rate hits, they call it. So working down, from 7 to 720 is in one tier, 720 to 740 is another tier, okay. 740, 760 is another tier. So you want to, depending on what tier you fall in, can affect the interest rate slightly. Again, we might look at that file and say, hey, that you have a high credit balance on this credit card, pay this down to X amount, your credit score is going to be X in 30 days. I could actually lock you the rates in that day of, and then we could backtrack with a higher credit score prior to closing back to that rate lock day and adjust the rate. So let's say, a month from now, we lock a rate in today. A month from now, prior to closing, credit score's higher and rates went up in those 30 days. I can go back to the lock day and adjust that rate to give you that better price on that day of. So some unique things that we could do. We could also have you pay off debt at closing. So I have some clients where we do a cash out refi and they don't qualify. Right. What we could actually do is have them pull the cash from that refi, pay off debt at closing to qualify them. So that's very helpful as well, where even though the debt-to-income ratios are too high by guidelines, by us paying that debt at closing, the debt-to-income ratios are now lowered, and we can move forward with that refinance. And then they're also saving that money monthly as well. So yeah, the credit score is very important though to do refinance. And there's sometimes where we sometimes tell a client to hold off for a little bit and let's work on the credit scores, get them that better rate. It all kind of depends on the market, what the market's doing. If it's a steady market, maybe we'll hold off a little bit. If it's a market where we're rising up, maybe we'll lock them in and get the process going right away and have them rebuild their credit while we're going through the process.
Okay. So basically there's no cookie cutter plan, right? I always say that in finance too. Everybody's in a different position in their life. There's no cookie cutter plan. We got to, take a holistic view of everything everybody has going on and go from there, start the planning process from there. So looks like you're doing the same thing on the finance end of thing or the mortgage end of things. So, well, listen, Ann,
yeah, it really
sure
depends.
We can go on and I'm sorry, go ahead. Yep.
No, I'm sorry. No, it really depends. Just take a quick note on that. Like if we have a VA loan, the credit score could be lower versus like a conventional loan. So it kind of matters on the loan product. A rate and term refi versus a cash out refi. You're going to want to see a little bit higher of a credit score on a cash out refi versus a rate and term. So there's different hits on different FICO scores for different loan products and different guidelines of that loan, whether you're doing a rate and term, you're doing a cash out. So it kind of really is a case by case scenario. And we look at the full picture and make the best decision to help the clients out.
Yeah. I think we actually spoke about doing a episode here on the podcast on credit scores and how important they are. So we'll have to revisit that. Maybe I think that can, we could probably spend the whole episode just on that alone. So,
sure, absolutely.
But great. Listen, I'm sure we could go on and on with questions about refinancing. Am I missing anything that maybe you want to share with our listeners?
No, I think we hit on most of the, all the key items. A lot of times too, we don't need appraisals on a lot of the files. We're seeing what's called an appraisal waiver, which is really good. So that means based upon market data, when we run the files through the system, they're not requiring appraisals. We've been seeing a lot of that the past 15 months or so. So that's pretty good too. So one less cost of the refi there. But yeah, pretty much we we touch on a lot of topics. There's really not like a one case for everybody. It's kind of case by case scenario where you really need to dive into the full financial picture and the long-term objectives to make an educated decision or help the client make an educated decision what's best for them.
Perfect, Ant. Well, listen, as always, thank you for taking the time to educate our listeners, and you truly are a wealth of knowledge in and around mortgages for our law enforcement community. So we want you to be safe, and we'll talk to you soon.
Thank you, sir.
All right, great. As always, Anthony, a wealth of knowledge, gave us a lot of information there in that interview. So 10-11, prepare a copy. Let's go over some of the things that we can take away from this episode. All right, refinancing. Refinancing simply means that you are replacing an existing mortgage with another mortgage with a different rate and term. So you pay off your current mortgage with the proceeds from the new loan. A general rule of thumb when you are refinancing, you should have at least 20% equity in your home if you want to refinance. 20%. That's the rule of thumb. If your equity is under 20%, but you have a good credit rating, you may still be able to refinance, but your lender may charge you a higher interest rate or have you take out mortgage insurance, which is PMI. Okay. So let's go over some reasons that homeowners might refinance. Right? Some of the reasons that you might want to refinance, maybe to obtain a lower interest rate. Obviously, with interest rates being so low, lately people want to refinance to lower that interest rate and lower their mortgage rate, their monthly mortgage rate. Right? Maybe you want to shorten the term of their mortgage. Maybe you want to go from a 30-year to a 15-year. Or maybe you want to convert from what they call an adjustable rate mortgage, which is an ARM, right, to a fixed rate mortgage, or vice versa. Maybe you want to go from a fixed rate to an ARM, to an adjustable rate mortgage. Or maybe you want to tap into your home equity to raise funds to deal with maybe financial emergencies or some sort of large purchase, or maybe to consolidate debt, right? You could take you could cash out is what they call it. You can tap into your home equity, get a cash out loan, and you can take care of some of those things that we just talked about, like a financial emergency or some sort of large purchase that you had planned or debt that you want to consolidate. All right, there are some downsides we have to worry about too. So the number one downside to refinancing is the cost, right? The cost to refinance. And what you're doing is taking out a new mortgage, like we just talked about, to pay off the old one. And when you do that, you'll have to pay most of the same closing costs that you did when you first bought the home, right? Your origination fees, your title insurance, your application fee, your closing fees, they're all rolled back into that new mortgage. So it could cost money. That could be a downside. We talked about the break-even period, and the break-even period is the time that it takes you to recoup those closing costs. So how long is it going to take in order to recoup those closing costs that you put out to refinance? All right? And we did touch on credit score, which is very important. Anthony told us about the credit score and how it plays a part in refinancing. And the higher your credit score, the more likely a mortgage refinance lender will work with you to get a new loan. Okay? So a lot of information there in that episode. Anthony did a great job breaking it down for us. If you want to get in touch with Anthony directly, you can contact Team Marone. Or you can contact me here in the office, 732-876-3777. I can put you in touch with Anthony as well. Or you can email me. My email is on the website, shorepointadvisors.com. And again, great episode. Anthony gave us a lot of information. So if you're thinking about refinancing, maybe this is the time to reach out. All right, with that, this is another episode of Shore Point Advisors Financial Roll Call with James Fay. We'll be 10-7 out of service.